Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, January 28th, 2019. We'll do a quick update here for members only. We'll cover the broad markets, oil, whatever else we've looked at lately, semiconductors, and that'll be about it. We'll keep it short. All right, so really, again, not to sound like a broken record, not much has changed in the last week or so. Mostly sideways trading, as you can see here. It's, short-term toppy action, but again, nothing has changed in the technicals. We had the breakdown right here. There's your breakdown below the 60-minute clean bearish rising wedge patterns. First little wave down, kickback rally, and now we're moving down again pretty impulsively today too. That's a good sign, about 1.73%. And we are at support. I need to mention that as well. There is some support right there. It's been traded through recently, and this has been traded through in the past quite a bit. There's still enough reactions that I have that line there. You can see reactions along the way. So that's worth pointing out, gaps as well, reactions. But the more you trade through a level like this, the less valid it comes. And either way, it would be what I would call minor support. Let's just leave it at that. So there's QQQ at minor support. We still have our first target here, second target. And like I said, there's still the potential I may extend this trade. When you see an official trade, and by the way, if you're new to the site or if you're not clear, the official trades, that's almost always when I list, well, they will always have official targets. I'll say T1, T2. Otherwise, on the unofficial trades, because it's quicker to get out, I'll just show the actual, I'll turn the level on the line, show you the actual support levels, and then I usually cover above there. So for example, T1 is 158.81, but the actual support level's at 158.78. So I plan to cover, 3 cents above. Now I'll probably hold my own position. I'm just saying for those that want a quick, well, actually, it depends what the charts are doing at the time. I shouldn't say what I'll do right now. At this point in time for swing traders, let me keep it simple and talking the money that I have in like IRAs where you can short QID or SQQQ. That I plan to hold out here. The active trading account, even though I'm trading NQE mini futures, I'll probably cover some at that level. It depends how we get there. See, that's the thing, and that's why my trading plan is somewhat dynamic. For example, if we just plunge today, let's say, we're already down 1.65%. We hit that level. You can bet I'll be covering right there and probably reversing for a long trade, especially if I see anything in the 5-minute charts, 15. Why? Because we'd be extremely oversold on the very short-term time frames. Not here, not so much on the 60-minute, and certainly not on the daily time frame, but on the short-term time frame. So when you fall down to that level, it's pretty well defined. I'd put the odds at 90% or better that you get at least a tradable, small tradable bounce off that level. However, if we were to, let's just say, hold this level, kind of work our way down there, come in here, consolidate for a while, and then tag it, well, we might have a very minor, if any, reaction, and then come on down there. Because if you do that, you're not falling down to it with very oversold. I should have said oversold earlier if I didn't. You wouldn't fall down to it with very oversold short-term conditions like this. So that I just want to share that goes into play. And again, you flip over to, or at least I do, to the shorter term charts, 5-minute, 15-minute charts. Do they indicate any type of bounce? Is there maybe a near-term selling climax? When you look at short-term charts, 5 minutes or so, you're always going to see high volume around the open and closes like this. That's just normal. In fact, I've always said this, that volume on any given trading day typically resembles a smiley face. Here, I'll show you what I'm talking about. Let's do this. Just move those volume bars up. And right here we go. So here's daily volume. I think you can see the daybreak lines. If you can't, let me turn those on. Day grid lines. There you go. So those are daybreak lines right there. And I talked about this recently with trade ideas too, when you're trying to determine if they're on above average volume. But you can see for the most part, the volume throughout any given trading session looks like a smiley face. Here we had some spikes during the midday. These are And these are what I was referring to a second ago. Here's a selling climax. You had a sharp move down intraday, and then on a very large volume surge. You usually don't get that. On a normal trading day, and there's not a lot normal about this market, again, you'll have volume sort of resemble a smiley face, meaning largest at the open, tapering off around lunchtime. This is when traders and investors, retail traders, everyone's taking lunch. And then, of course, towards the end, that's when the ETFs and the funds do their rebalancing. So that's what usually happens there. I'm telling you that to keep that into account when you're calculating the volume on a breakout on a stock. But then also to look for these potential selling and buying climaxes that may come throughout the intraday session. So going back to where we were, and again, maybe it's off topic, but this is just, I'm sharing some thoughts with trading. If we had that sharp plunge down and a pretty high volume, some very high volume that really stood out, big red candle, hit that level, that'd probably be a near-term selling climax, and then you could follow by a bounce. But if we just limp our way down there and we don't have any type of selling climax and we hit 158.81, probably just continue to hold on to that swing position to down here to the second target. And again, that's the plan as of now. If we do kick up here, keep in mind there is a downtrend line. I wanted to cover that as well. Here's a downtrend line, comes off the highs. There's a couple. What I'm trying to do here is lay out a potential bullish scenario we'll have to keep our eyes on. The PPO 9 EMA, my 60-minute trend indicator, is still bullish. That's that dotted white line. It's still above the zero line, has been since all the way when it crossed back here. So this has told you the trend is bullish, at least by this metric. So we have to watch that. And that zero line, as I said, often acts as support when tested from below, like it did here. It acts as resistance when tested from above, or support when tested from above, resistance when tested from below. You can see there. And other than that, it helps define the near-term trends, the very near-term trends. So we're watching that and that trend line. And let's jump out to the daily chart and see what it looks like. Here's that downtrend line on an even larger scale here. You can see some pretty clean reactions so far on QQQ on the move down. 1, 2, 3, very distinct reactions. So that third reaction there helped validate this trend line, and we haven't hit it yet. So let me say it this way. Not my most, but one of my more bullish scenarios would have the markets just kind of holding up here after today, and then making one more thrust up. Hopefully that'll keep us in the QQQ trade. If I see a compelling reason, I would extend the stops, but as of now, I'm just sticking with what we have. But we could hit this before we have that 5-6% correction I'm looking for. But I would prefer, and my preferred scenario is right now, to see us go on down, hit the targets on the QQQ short trade, then come on up, and we'll target that trend line for maybe the next hit for both either a long trade to get out of and or maybe to put on a short trade once again, depending on how the charts look, if and when we get there. Okay, and then moving on to the indexes, small caps. For those of you that trading the small caps, I like those as well right now on the short side. The same story. The charts are playing out, albeit a little slower than I'd like to see. We did break down. We hit that first support target. These levels were all shown before we even, either right after we broke down or before we even broke down. And so we hit that first support target, first support level. I didn't categorize it as a target. Obviously, one could have taken profits there. Support levels where I expect a reaction, but it wasn't enough meat on the bone, in my opinion, to even make it warranted, covering a short position there. So we had a reaction, and hopefully it'll continue to play out, along these lines here. And right now, if I'm not mistaken, this target here, about 139, would align with that T2 on QQQ, if I'm not mistaken. And of course, as you can see here, if things get pretty ugly, maybe we come down there. And SPY traders, everything looks the same. The bigger picture here, and again, why nothing's changed recently. Very clean, bearish rising wedge patterns, confirmed with negative divergence, overbought readings, and we had effectively, I mean, ever so slightly, maybe roughly an equal high, maybe a hair lower, but on all of the QQQ, IWM, everything I just showed you in SPY, you can see the divergences have only steepened. In fact, we did not have RSI divergence when the wedges broke down. We did have those extreme overbought readings. Now, or as of last Friday, I should say, on the kickback rally, that gave us divergence there. That actually helps increase or strengthen, in my opinion, the bearish case on the charts here. So you can see the levels on SPY if you're a SPY trader. Okay, crude oil, here's USO. There's the wedge that we had, the rising wedge I showed you before, this white line. So we had a breakdown right here. You can see the breakdown of the rising wedge. Very impulsive. We back tested, rode along. And what I did today, this morning, I added an alternative trend line, which also comes in and captures all those lows. That one's also been broken with a gap down. Gap down, nothing is more impulsive. It doesn't look like much when you're eyeing a chart because you see just black space. You don't see a big red candle. But that is effectively what that was. If you're looking at, say, the futures or whatever, a gap would be comparable to a big red candle because that's a down move there. Of course, there weren't any trades, so it doesn't show it. So that's about as impulsive as you get. The fact we gap down below there, I'll get to CL in a second. But again, just like the markets, and I said this, the crude's been trading very much in line with the stock market since the lows on the 24th. And I'm watching this trend indicator. We're testing it now. We already had a couple tests on it. So, tap, tap, tap. Sooner or later, the more times you test a support level, the more likely it is to give way after tapping on it. So we'll watch that. Here was the last time we had a cross down on that 9 EMA right there on crude. It said that the trend flipped after a brief little rally and bullish sell buy signal there and a little bullish trend. It said, this period you should be short crude. Here you should be long crude, and then actually still long, but look for that breakdown again. Pretty effective trend indicator. You can see, going back here for months now. The only time it was above the zero line was right here for a little bit, and then crossed here, and we're still there now. So we'll see if we get that confirming sell signal, if you will, that'll open the door for a little more downside in crude. DWT, unfortunately, they ran our stops. That's just part of the game. I've talked about this in recent months, especially a lot last quarter. There seems to be I've noticed a very marked increase in stop rates on a lot of the trades I have. As I often share, I like to use a 3-to-1 or better risk-reward ratio, and that's worked for many, many years. But I think, and I've said this before, that it seems in recent years the algos and the market, whatever you want to say, conditions have adapted to that. And I may start on some of the official trades, and I actually have. I've mentioned this before, and I've done it on a few, and it worked. Extend those stops. You may start seeing trade ideas, official trades that come out with a 2-to-1 RR ratio, because, and I plan to do this too, maybe go through a video of all the trades that have been stopped out in the last few months and kind of go over those, because I believe with very few exceptions, they all would have played out after just barely having their stops hit, just like DWT here. We had quite a few, as you guys know, on the right before the bottom on December 24th, some couple trades that stopped out and would have, went on to play out exactly as expected. So just food for thought. And as always, somebody in the trading room said, "Hey, Randy, thanks," because I shared my thoughts when this was stopped out. I said I still like it. I'm still long crude. Do what you want. I'm sticking with the trading plan because there just wasn't enough evidence in the charts to modify that, but I know a lot of you did hold on to that, and congratulations. But I just want to say it looks good from a technical perspective. Anything is possible, so you still don't get married to it. Sometimes the best looking chart patterns just don't play out, but there was a breakout, a back test, another move down, and so far we're moving up. But when we look at DWT right now, I would add a line right here because we've had several reactions, 1, 2, 3 since the breakouts. Basically right where we're at now, DWT needs to pop this level with conviction because that's minor. We'll call that minor resistance. So let me take that line away, and same targets that I had before if you're in that one. Let's see. There's NQ, the Nasdaq 100. I've shared this. I haven't changed this since Friday. I put that up, I believe, in the trading room or on the front page with resistance levels, targets. Let's see what else I have here for you, futures-wise. ZB, short-term Treasury Bonds, same story. They broke out, kind of like the market. Remember, they're going to trade inversely to the market, Treasury bond futures. So those are the 30-year bonds. Still looks good. ZT, the short-term 2-year bonds break out, and just, again, mostly sideways trading because the market hasn't corrected. So if we continue to correct, I think Treasury bonds, both short-term, what we're looking at here, all the way out to the long bond I just showed you on CB, those should rally. If, again, depending on what the market does. And if you're trading all of those, if you're trading anything that I'm covering here, the equity indexes, crude oil, or treasury bonds, remember you're going to have, we've seen a very tight correlation, the return to the norm. We didn't have that in the, starting out the fourth quarter last year. There was an unusual disconnect where their regular relationships or correlations were not working. And now they have been. My point being that if you are long treasury bonds, short crude, and short the equity markets, you don't have a lot of diversification. Yes, those are three completely separate asset classes, as separate as asset classes can get. However, your correlations are very high, so you might as well just be trading, SPY, QQQ, and IWM, because right now, and again, this correlation could disconnect, but I just want to point that out. So part of trading, one of the most important parts of trading as well as investing is diversification within a portfolio. And diversification, you can have 100 different positions, stocks, ETFs. It doesn't matter how many you have. If there's a high correlation between them, you're not properly diversified. Proper diversification means different sectors, asset classes, and most importantly, whatever they are, that they don't have a high correlation among each other. And finally, let's look at SOXX here, another trade. Looks like I'm missing a line here. Where did that line go? Either way, the stop was at is at 174.90 over that. So any move of 174.91, if I can get that there. Let's change that to 91. That would be a move over 174.90 and color that line red. 92. There we go. So there's your stop. They sure tried to make a run at it, but it was a well-placed stop so far. And this is what I call referred to as a momentum-fueled overshoot. When you have a nice pattern, like we had a clean bearish rising wedge, we had negative divergence at this point. You can see the divergence on the wedge. Momentum-fueled overshoots, again, it's just a term I made up, that when you have strong momentum within in this case, a bearish rising wedge, and the same thing works in inverse on a bullish falling wedge. When you have strong upside momentum, sometimes you'll pop above the wedge briefly and then fall back in. Now the move back in, this proved to be a failed breakout, if you will. And more importantly, it was on the daily chart. I had a key level here about 170.80. That was a resistance level that I thought was pretty significant, and that's where why we shorted the semis. Go back in time, there were a lot of reactions there. So we popped above it impulsively on Friday, but then failed back, dropped below it today. So that to me is it's certainly a failed breakout, and it's also most likely a bear trap. I'm sorry. Did that in reverse, a bull trap. We popped up. So bad for the bulls. And it also, as I mentioned last week, we had the 200-day EMA, and that's another reason we shorted there. 200 EMA was actually acting as very nice support on the way up and resistance on the way down. We popped it. If you guys remember, the markets did that. QQQ and everything else did that back in the last, fourth quarter. We had that strong big green, it looked almost identical, that big green pop above the 200-day EMA. And at the time I said, I showed you what happened back in 2007 right after the top, or early 2008, same thing, that it was temporary, and then it was we gave back up the 200-day, and the rest is history. So the market fell, and there was another pop there. Actually, this was the one we popped above both the 50 and the 200. That was it right there. And that also proved to be a bull trap false breakout. So that's similar, if you will, to what I'm seeing right now in SOXX from Friday, that candle right there that took out the 200 plus price resistance. We're back below it. So as long as we remain below it, resistance once taken out becomes support. So when we popped it, 170.80 should have acted as support on a pullback, but it didn't. And support once broken becomes resistance. So at this point in time, it's pretty simple. Now the 170.80 plus the 200-day moving average is our resistance level to watch. So you want to see for the SOXX short trade, ideally you want to see, we're already on it, you want to see SOXX remain below those levels. And again, this is what the targets are and everything else. So I'll update you if anything changes. And I think that's it. I was going to see if there was anything else to cover. If I'm missing anything, I'll follow up another front page post, or anything minor, I'll put it in the trading room. All right, this has been Randy Finney with the Right Side of the Chart. Hope you enjoyed it.